Too much light in this window. Don't wake me up. Only coffee, no sugar.
Welcome to Chapter 2, Module 4. Hey, Sketch, ready to begin?
Do we have to? I can think of almost 100 things I'd rather do, with sleep being on the top of the list.
That's a college spirit. Yes, you bet. We need to start. Let's start by looking at the income statements for a merchandising company, both the traditional and contribution format. The traditional income statement organizes costs in a functional format. Costs relating to production, administration, and sales are grouped together without regard to their cost behavior. So, for example, cost of goods sold may have variable and fixed costs lumped together in it. We use this approach primarily for external reporting purposes.
The contribution format allocates cost based on cost behavior, separating out variable and fixed cost. This format is easier for management to use because variable and fixed costs behave differently for decision purposes.
Companies use the contribution income statement approach as an internal planning and decision-making tool. We'll use this approach when we discuss cost volume profit analysis, segmented reporting, budgeting, and special decisions such as pricing or make or buy analysis.
Woohoo! Just shoot me. I'm so excited.
Let's talk about a couple cost classifications used in making decisions. Differential costs, opportunity costs, and sunk costs.
If you think about it, every decision involves a choice between at least two alternatives.
The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. Costs and benefits that differ between alternatives are relevant in a decision. All other costs and benefits are irrelevant and can and should be ignored. To make decisions, it's essential to have a grasp on the three concepts: differential costs, opportunity costs, and sunk costs. Differential costs and revenues differ among alternatives that we want to make a decision about. Differential costs can be either fixed or variable. If you have a job paying $1,500 per month in your hometown, and you have a job offer in a neighboring city that pays $2,000 per month, and the commuting cost to the neighboring city is $300 per month, what would our differential revenue and cost be?
I think the differential revenue is $2,000 minus $1,500 or $500. And the differential cost is $300.
To decide if we take the job or not, we would consider these differential revenues and costs among other factors, such as the type of job, if we like the people at both places, or if either job advanced our career.
Don't forget the paid vacation days.
And, of course, the paid vacation days. Another type of cost to consider in decision-making is the opportunity cost. This cost is a potential benefit that is given up when one alternative is selected over another. These costs are not usually entered into the accounting records of an organization, but must be explicitly considered in all other decisions.
So, for example, instead of going to college, I could be earning $50,000 per year working retail. Then the $50,000 is an opportunity cost of going to college. Only thing is, I'm planning on earning a lot more doing the accountant thing, which means my opportunity costs are much higher.
Ah, yes. Opportunity costs are what you are foregoing by not choosing the next best alternative. Remember, these costs don't get recorded on the accounting records, but we need to consider them in our decision process. Another type of cost we consider in decision making are sunk costs. These are costs that have already been incurred and that cannot be changed by any decision made now or in the future. Since sunk costs cannot be changed and therefore cannot be differential costs, they should be ignored in decision making.
I bet it's human nature to consider sunk cost, even when we shouldn't. I'm thinking of my roommate and her creepy boyfriend. She is always saying that she wants to break up with him. But then she feels that she has so much time invested in the relationship. And he may get uncreepy if she just hangs in there a little longer.
Sounds like she's letting sunk costs, or in her case, sunk time, impact her decision. An example from the business world might be if we purchase gold for $1,100 an ounce and it's now selling for $950 an ounce. Should we hold on to it until the price rises above $1,100? Usually people say yes, but the original purchase price is a sunk cost, so it shouldn't play a part in our decision to hold or sell the gold. If we're trying to decide whether to take the train or drive to Chapel Hill, which of the following would be relevant costs?
Why would anyone want to go to Chapel Hill? That's like a complete waste of a road trip.
Well, that may be the case, but let's just assume that's what we want to do. Is gas a relevant cost?
It's relevant. We only have gas costs if we drive.
Right. What about parking at Chapel Hill?
Relevant again. We only have parking costs if we drive.
Sure. And how about the insurance?
I don't think those are relevant because we would have insurance costs whether we drove or rode the train.
You got it. And how about the original cost of the car and the semester parking permit at UNCC?
Well, those both feel like sunk cost and therefore irrelevant. We made them in the past and they can't be changed going forward.
Right again. And how about the fact that I'm a bad driver?
I would sure think that is relevant. No way I'm riding with you.
Excellent. Hey, ready to wrap up this module?
You bet. I'm thinking of catching up with my roommate and giving her a quick lesson in sunk cost and creepy boyfriends.
Look, there she is again.
And she still has that phone stuck to her ear. It's probably the creepy boyfriend.
Yeah, looking for a ride to Chapel Hill. See you soon.
Don't wake me up, don't wake me.